Hello, everyone, and welcome to our MicroMasters Program in Finance webinar. We're delighted you can join us today and look forward to seeing you in one of our courses, Foundations of Modern Finance or Mathematical Methods for Quantitative Finance, both of which are starting on September 21st. My name is Egor Matveyev. I'm the Executive Director of the MITx MicroMasters Program in Finance. I joined the finance group at MIT Sloan 5 years ago. I have taught various finance courses in our MBA, Masters in Finance, and MBA Sloan Fellows program. The scope of my teaching includes introductory classes to MBA students, Sloan Fellows, as well as an advanced elective in corporate finance. I also teach Sloan's Action Learning course in corporate finance and investment banking. My academic research covers areas of corporate finance, corporate governance, organizational economics, and asset management.
Hello, everyone. I am Leonid Kogan, and along with Professor John Wang, I teach the Foundations of Modern Finance course in the MicroMasters program. I have been with the MIT Sloan Finance Group since 2001. I taught in various programs, including the Master of Finance, MBA, and PhD programs. I have been involved with our Masters of Finance program since its first year. At some point as the faculty director, and I also helped launch and develop a number of courses, including the Foundations of Modern Finance, Analytics of Finance, Financial Engineering, and Finance Research Practical. My academic research covers a range of topics in capital markets, including theoretical and empirical analysis of asset valuation and market dynamics, with the focus on understanding the economic forces that drive various phenomena in financial markets. As it happens, I first discovered the world of finance at MIT. I completed my PhD here, and my prior education was in a very different field. It was in applied mathematics and mechanics. Learning finance here at MIT was a unique experience because many of the fundamental principles and the models of the field were developed here starting in the early 1960s. And as you dive into finance, you will learn about theories of capital structure and corporate risk management, valuation of derivatives, interest rate models, equilibrium models, dynamic portfolio choice. The list goes on and on. These are all examples of the foundational work that has been done here at MIT, and we cover many of these topics in our MicroMasters program. Let me say that we are excited and privileged to share the MIT brand of finance with all of you.
Hi, everyone. I'm Paul Mende, and I'm the instructor for the course on mathematical methods of quantitative finance. Like Leonid, I started out with a background in another field. I received my PhD in physics, not finance. And before coming to MIT, I worked in investment management. So I bring an industry perspective as well. I worked developing quantitative investment strategies, running algorithmic trading systems. And very much what we want to do is show you not just the theory and the mathematical tools, but their applications in the real world. I've been teaching at MIT now for over 10 years, and this course originated out of a course that we teach, another version to our advanced Masters of Finance students. And I also teach master level courses in financial engineering, financial data science and computing, and in undergraduate laboratory and investments. I also teach in our executive education program. My research interests are a range of topics in finance, including volatility forecasting and dynamics, derivatives pricing, and applications of machine learning to trading and price discovery in dynamic markets. I'll be working with you throughout the course, and I look forward to sharing more information about the course during today's webinar.
For today's event, our goal is to provide you with a comprehensive overview of the MicroMasters program, as well as Foundations of Modern Finance and Mathematical Methods courses. You will also have the opportunity to hear from one of our MicroMasters in Finance program credential holders, Nader Alatawi, who will share his experience of the program, as well as some tips for preparing and succeeding in our courses. We also want to answer your questions today. You can use the Q&A button that you see at the bottom of your screen to submit your questions related to today's webinar. There is an upvote feature, so if you'd like to hear an answer to questions asked by your fellow learners, please upvote them. At the end of today's sessions, we will answer questions you submitted during the registration, as well as questions asked during this live webinar. But before we begin, we have a question for you to answer. So please answer the following question that will appear on your screen right now. We're curious to know where you are joining us from. Excellent. So let me share these results with you on the screen. Thank you for your responses. It's great to see that you're joining us from around the world. As anyone who has taken any of our courses knows, the MITx learner community spans the globe and offers many opportunities for networking across industries and interests. Let me stop sharing these results. We begin today's session by giving you an overview of the MicroMasters program in finance. Our program consists of 5 courses: Foundations of Modern Finance, Part 1, Foundations of Modern Finance, Part 2, Financial Accounting, Mathematical Methods for Quantitative Finance, and Derivatives Markets. By completing all 5 of these courses, you will earn the MicroMasters credential in finance from MIT. How does completing the MIT MicroMasters program in finance benefit you? It can be used to advance your career, as well as be a first step in earning a master's degree in finance, either at MIT or at our pathway universities. Please check our MicroMasters program website for most current list of universities that accept our MicroMasters in finance credential. At MIT Sloan School of Management, for example, MicroMasters credential holders who are accepted into Master in Finance program can accelerate program completion by waiving the first semester. Now, I also would like to tell you what distinguishes our program from other programs that are available on the market. First, our MicroMasters program mirrors our on-campus Master of Finance program, which is a leading program in its class. We deliver courses at the same level of rigor as the MIT residential program. And importantly, all our courses are taught by the same faculty as the residential MFin program courses. Second, MIT has a deep tradition in finance with its own unique flavor. Our approach emphasizes unifying fundamental principles of the field, a coherent, rigorous approach to financial decision-making across the diverse areas of applications. For example, corporate finance, asset pricing, investment management, risk management, just to name a few. You're welcome to pursue the whole program, or you're welcome to take our individual courses. For example, if some of you already have a strong general foundation in finance, and you would like to deepen your understanding of derivative securities and markets, you can take our derivatives course and earn certificates specifically for that course. In all our courses, we have developed individual exams that allow us to test your knowledge and you to show your understanding of the subject. Our testing process is rigorous and complies with our internal practices for MIT students. Earning credentials will allow you to demonstrate your knowledge and skills at the highest level. And now I'd like to provide you with more detail about each of our courses. The program consists of 5 courses: Foundations of Modern Finance Parts 1 and 2, Financial Accounting, Derivatives Markets, and Mathematical Methods for Quantitative Finance. Learners may begin the program with any of the 3 entry points courses. These entry point courses are Foundations of Modern Finance Part 1, Financial Accounting, and Mathematical Methods for Quantitative Finance. Foundations of Modern Finance is the fundamental course, foundational course, and in our program. And we cover, we split it in 2 courses, in 2 parts. So Foundations of Modern Finance Part 1 and Foundation of Modern Finance Part 2. So these two courses together provide learners a rigorous introduction to the fundamentals of modern finance and their applications to a variety of business decisions, such as valuations of assets, securities, investment decisions, risk management, and corporate financial decisions. We advise our learners to take both of these courses and, of course, to take them sequentially. So you start with the first course and you continue with the second course, because the second course really builds on the first one. The third course is the financial accounting course. It focuses on how companies provide financial information to outside stakeholders, like stockholders and creditors of corporations. To understand a company, whether you are chief executive officer and need to make key strategic decisions, or you're a hedge fund manager deciding on whether to invest in a particular firm, you must be able to read financial statements. So this course really teaches you to analyze and understand financial statements. For this reason, this course is a required course in most Master of Business programs. Now, Mathematical Methods of Quantitative Finance provides learners with advanced mathematical topics in financial engineering and quantitative finance using linear algebra, optimization, probability, stochastic processes, and statistics. You will learn the applied computational techniques frequently used in the field of finance. And so finally, our fifth course, Derivatives Markets, Advanced Modeling and Strategies, provides learners the economic intuition and technical skills necessary to understand how to use derivatives for investment and risk management purposes, and how to hedge and price them. Upon completion of this course, learners will have a sophisticated understanding of tools for valuation and for quantifying, hedging, and speculating on risk. We recommend that learners take Foundations of Modern Finance Parts 1 and 2 as prerequisites, and we do require them as prerequisites for derivatives markets, as derivatives markets build on the foundational material that we deliver in Foundations of Modern Finance courses. Now, the complete schedule for our courses can be found on either edX site or on our program website. You're welcome to scan QR codes that you see on your screen right now. Our program website contains also answers to some of the most frequently asked questions. So this is the second link and the second QR code that you see on the screen right now. And so with this, now I would like to turn this over to Professor Kogan, who will give you a preview of the material that we teach in the Foundations of Modern Finance class.
Thank you, Igor. So let me tell you all a little bit about our first course, Foundations of Modern Finance, Part 1. This course establishes the major principles that underlie modern finance. We develop frameworks for valuing financial and real assets and businesses, corporate investment decisions, and more generally for investment under uncertainty. We will also develop asset valuation tools, which are used in both fixed income and equity markets, and methods used by both quants and fundamental analysts. So as an example, consider a problem faced by a company CFO. This is one of the CFO is choosing among several projects that the company may undertake. What do they need to do? What do they need to know? They need a consistent decision criterion. They need to be able to forecast cash flows of these various projects. They need to figure out how to attach value, dollar value, to random future cash flows. So we're going to learn how to handle each step of this problem throughout our course. We have been teaching these topics to our students at MIT, and we are excited to share this course with all of you. And now to give you a taste for what we do in the course, let's run a quick experiment. So take a look at the following. Could please launch the poll?
We have about 75% of participants already answered. So let me wait another few seconds. So 80. All right. Let me show the results. So Leonid, roughly 64% choose purple investments, followed by 25% blue, and 9% red, and nobody likes green investments.
Perfect. So these results are very much consistent with what we see in the various experiments, in particular with our residential program students. So let's take a look at what these lines represent. So these are various real investments, and you could see what they are. So the green line, which doesn't get a lot of attention from the audience, is actually US Treasury bills. The red line is something that most of us actually invest in, that's the US stock market. And the most popular investment is a single stock, Pfizer. Now let's take a look at how these investments did going forward. This is after the shown sample period. So going forward, the treasuries did basically the same thing as before. They're rising slowly but steadily. The stock market did quite well, as you remember, recovering after the global financial crisis. Pfizer did extremely well during the next decade. And let's take a look at the purple, which is the most popular investment. So as it happens, the purple investment, that was a Ponzi scheme. That was the Fairfield Century Fund, which was managed by Bernie Madoff. Of course, it was a pyramid, and that fund blew up subsequently, and its value went down to zero. Now, in retrospect, one may have guessed that there was something funny going on here, because if you compare all of these investments over the initial period that I have shown, the purple line seemed to be extremely low risk, just like US Treasuries, but its performance was comparable to the US stock market. That's what we call a free lunch. You're basically getting high level of performance without apparently taking on any risk. And as it became apparent down the road, the risk was always there. It was simply not apparent. Now, with that, let me ask you another question through the poll, which is, do you think financial markets are efficient?
So we have almost an equal split. So between yes and no, and 13% don't know.
All right, very good. So this topic, of course, attracts a wide range of opinions, often strong opinions. Now, our previous example, of course, was kind of a negative example in the sense that the outcome was pretty bad for the investors. Market efficiency, if you go with that, would have told you to avoid the purple investment. So in that case, it would have served you very well because efficient markets basically say that you can't have high returns without taking on risk. And so when you see something that looks too good to be true, it has to be too good to be true. There is some kind of hidden risk. But let's look at a positive example, which will hopefully give you some food for thought and reinforce the notion that you should respect the wisdom of crowds in financial markets. So this example is from 1986. So if you recall, in 1986, Space Shuttle Challenger exploded shortly into its flight. And this explosion was reported by various news agencies. Defense contractors, various kind of airspace contractors who were involved in constructing the shuttle, they immediately responded with the statement that they have no comment. It was clear that someone will have to take the blame for that. That's going to be very detrimental to the business. At that time, President Ronald Reagan established a presidential commission to investigate what exactly happened with the launch. And Richard Feynman was on that commission. He was the leading physicist of the day. And 6 months later, the commission published a report where they found that the reason for the explosion was a particular kind of failure of one component, which was this rubbery insulation ring, the O-ring. And the contractor who produced this component was Morton Thiokol. Now, if you look at the stock market action around this event, this is minutes into the event, what you would notice is the following. Very shortly after this, basically seconds into it, the market value of these various contractors dropped because it was clear that someone is going to be responsible. It was not obvious who. So you see here companies like Lockheed Martin, Morton Thiokol is one of them, Rockwell, and all of them drop in value. And then as time passes, and we're not talking about 6 months, we're talking about minutes, basically about an hour into it, something starts happening. Basically, there is now divergence. Some of these companies, they start recovering, but one of them is not. So the company that did not recover, in fact, it fell further towards the end of the day, was Morton Thiokol. So it appears that the market figured it out by the end of the day, within a matter of hours, that the company that will ultimately be responsible is most likely Morton Thiokol. Now, how did the market know? It doesn't have crystal ball, of course. It's a wisdom of crowds. What's going on is that information has been out there in the population, and in particular, some engineers and at Morton Thiokol, they knew that there was a potential problem with the shuttle, and they were trying to stop the launch. They were petitioning NASA to postpone the launch because they thought that the shuttle may blow up. Something went wrong along the chain of command, and that the launch did take place, but the information was there, and markets managed to aggregate that insight and impound it into prices very quickly. And that's an example of the wisdom of crowds that you see in financial markets. Financial markets are highly competitive, and any piece of information that can give you an edge in terms of being able to outsmart other traders, it gets exploited and eventually shows up in prices. So that's just one example, which will hopefully give you kind of a sense of the kind of dynamics that we're facing in financial markets and a sense of respect for market efficiency. So in the course, we're going to, of course, dive much deeper into this topic. If in doubt, enroll in Modern Finance 1.
Great, thank you, Leonid. And yes, let me mention that we obviously continue exploring all of the risk and return and market efficiency related topics in this very first Foundations of Modern Finance course. With this, I would like to now turn this over to Professor Mende, who will give you a preview of the material that he teaches in the Mathematical Methods for Quantitative Finance course. Paul?
Good morning, good afternoon, wherever you are. Welcome to the webinar, and I look forward to seeing you in our MicroMasters program. What I'd like to do is go over the main topics for the Mathematical Methods of Quantitative Finance. And I see there's already a question in the Q&A about prerequisites, and I do want to mention that. And let me put up here right now a QR code and a URL where we've set up a site where we list in detail not only what the prerequisites are, but a way to check yourself whether your mathematical background is at the right level or whether you might need some review or if there's some topics that are missing. And we've also provided, in addition to that self-assessment, study materials, sometimes in the forms of books, but many online lectures that are from terrific courses elsewhere that are background for things that are not finance related, but that we're going to be assuming coming into the course. So it is important to have a good background for the course. It's not meant to be exclusive, but it's not meant to be self-contained. So I'll mention this at the end as well, but I did want to put it up here up front since I saw the question already arose. So what do we do in the course? We cover a few main topics, and they're listed here: probability, time series analysis. We do continuous time finance. We look at linear algebra in the context of market structure, and it's used for asset pricing. And we look at optimization. The basic things that we have that are in common with the finance themes that Egor and Leonid have mentioned is that we're trying to describe a world that sometimes looks very random. So there's a lot that's going on. I like looking at data as well as at equations, and I'll show you a few of both. But one of the things that we do in this class is to quantify and build mathematical tools for helping to grapple with and solve the issues that Leonid raised, namely, how do we describe uncertainty? How do we measure it? How do we come up with a decision criterion, a single one, for choosing projects that could be done in an optimal way? So the approach that we have is that really of an applied math class, which this is. We're not doing a lot of theorems and proofs, but we will be doing some advanced mathematics. We're going to be looking at calculations. We're going to show where the results come from, and we're going to apply them. Now, you might notice that the list of topics actually covers a whole bunch of things that in a usual university curriculum might each be a semester course. So think of this as being a little bit the greatest hits. We've plucked out those things that are particularly important for finance. And if you do have a background in those subjects and not that much exposure to finance, I think you'll also find the course especially interesting, because many of the problems in finance are terrific places to check your understanding. The problems in finance are hard. The worlds and the financial markets are changing. And as Leonid mentioned, it's very competitive. There are people out there looking for every possible discrepancy, so we want to be on top of things. The course is very much hands-on, so you will need to get your pencils sharpened and do some work, and I'll be doing examples in the lectures. We'll have them in the recitations, and there'll be a series of problem sets. So it's not using a calculator that we might in foundations, or a green eye shade that we might along with our sharp pencils in accounting, but writing down some equations and doing some algebra and doing some calculus. The first topic is probability, and we need to know that just because the world is uncertain. There's a lot that's going on, and probability is the language for describing uncertainty. So we see things like the growth of the market. Behind me, we can reduce that to a time series, a distribution of changes in the market, and then look at what the distribution is. What shape is it? So we look at reviewing some of the basics of probability just for capturing a descriptive picture of what data looks like in actual markets. Then we move on to dynamics. After all, things change over time, and that's what we want to see. So time series analysis is the study of the evolution of economic variables over time. We have a couple of models, the classic random walk model, which is an example, a model that makes concrete the way markets would look under a world where markets were efficient, as Leonid mentioned before. But we look at other applications, models where there might be serial correlation and possible predictability. So in fact, I would say that kind of the key focusing question in this part of the course, or the key motivating question, one of them is, are asset prices predictable? You know, are they random? Is there information there? And if there is, could we take advantage of it? So this is both theoretically important and it's very practically important. We have a world of difference between academic theory that says markets are efficient and a whole industry of people who vote with their feet and say they're definitely not. So who's right? Well, you'll get to decide. You'll get to have the tools and you'll get to look at some of the data. Our models don't always work, and we try to build models, but some things, you know, no matter how quantitative or mathematical you are, I don't have a theory of GameStop, of meme stocks, or of Reddit boards. So there are things that are outside the scope of what we do. And that's also a good check too on your own understanding. What are the results that we have, but also what are the counterexamples? So sometimes our models have limits and they won't describe everything. We'll look at the limit where the time intervals get shorter and shorter, and we'll look at some celebrated results in option pricing theory. And this is a part where we don't expect anyone really has had this mathematical background for doing Ito calculus. What a formula in the box is called Ito's lemma. You might recognize, I hope you recognize, the first two terms on the right-hand side as being the chain rule for differentials for a function of multiple variables. But the third one looks like a mistake. It looks like it shouldn't be there. And it turns out, for reasons that we'll get to see in the class, that's essential when we're looking at variables that are not deterministic, where there's uncertainty and randomness in the world. And applications of this are option pricing and looking at yield curve modeling in fixed income markets, looking at corporate issues like probabilities of credit default. So let me ask you a question. Let's take a look at a particular market, and I'd like to ask you a question. So this is a graph showing the history of the pricing in the oil market. And you notice here that the price of oil, I grabbed this screenshot this morning, is around $86 a barrel. This is over the last 5 years. It's been 5 years ago, it was closer to $40, $50 a barrel. So suppose you had a chance, you're looking at your screen and you see the price of oil goes to $5. Are you buying or are you selling? Oh, you have to vote. So finance isn't a spectator sport. We want to get 100% here. You got to vote. It's like playing poker. Except I'm not going to let you fold. Okay. All right. Great. So let's see what people think. And most of you are buyers. And why are you buyers? Well, we buy things. We want to buy low and sell high. When I was in the industry, I used to say we had two strategies: buy low, sell high, and sell high and then buy low by going short. So most of you are buyers. A few of you were sellers. And it's interesting to see what this is. We're about 5-to-1 buyers to sellers, but $5 a barrel, such a deal. It's 86 now. Well, what was going on? Actually, remember that if we're buying at $5, we only make money if prices go up. But in fact, what happened is that little blip in the middle of the graph is the period when prices did go to $5. And if you look closely at the axis, you'll see something rather unusual, which is the prices went negative. So this happened right after the start of the pandemic, and oil prices at the end of April for futures contracts for May delivery is the white line that you see at the bottom of your screen. And they were at $5, and then they went down even further. So now suppose you're watching your screen and you bought some. Normally, if you buy an asset, what do you do if the price goes down? Well, if you thought it was going up, maybe you were wrong and maybe you'd better get out. On the other hand, if you thought it was going up, now it's even cheaper. Maybe you should buy more. So let me ask you this. You see your screen and you say, wait a minute, you rub your eyes and you say, oh, now oil is negative. It's minus $5 a barrel. Are you now a buyer or a seller? While you're voting, I'll comment on the two other lines in the top. The red and the blue lines were for subsequent months delivery, and the prices were very low, but they didn't go negative. It was only the April one that was for May delivery that went negative. So we still have a bunch of buyers and a bunch of people now sitting on their hands, but in fact, the price bottomed out at minus $40 a barrel. So if you were buying at 5 or at minus 5, the price dropped even further. And that's not usually something that we see or that we think about. And why do I mention that? Well, one reason I mention it now is not just it's a quirk of the markets, but it's something you won't really find in the textbooks. And what we're trying to teach you to do, all of our students at MIT and as part of this program, is to be able to solve new problems, not the classic ones. So this is something, in fact, most books will start with the statement that asset prices are always positive. Now that's true for stocks because corporations have limited liability. It's not true for commodities that have a cost of carry. What happened in this particular case was that if you were on the long position of the contract, you were obligated to take delivery. And in April of 2020, no one wanted oil. No one was using, everything was shut down. All the storage capacity was filled. And if you had the oil, there was no place to put it. So people were paying a lot to get out of their contracts and an asset became a liability. So it's new territory, but guess what? The exchanges on which these contracts were traded, they'd seen this coming. They'd anticipated this. And there was a variation of the usual Black-Scholes-Merton model that goes back actually to Bachelier to the year 1900 that worked just fine and did handle negative prices. So the exchanges were ready for this, and they had models that were ready to go that were someone came up with and were interesting generalizations that handled a new situation. So what we want you to be able to do is not just know what the standard rules are and the typical results. We want you to be able to apply them to new situations. And these are the kinds of things that make the finance industry so interesting, is dealing with these kinds of results. Last thing I'll mention, or I'll mention two more topics quickly, which are linear algebra. So we use linear algebra as a standard tool for describing portfolios, for describing lots of variables. And there's a very natural way that we would do it. For example, if you have a 30 stock portfolio, you could think of the number of shares you have in, say, Apple as the first component of a 30 component vector, the number in Amgen is the second component, and so on. And this obeys the usual rules of linearity, namely that, the number of shares you have of Apple plus the number of shares you have in Amgen, you can put into a portfolio, and it's the sum of the two parts. And a portfolio with 100 shares is 100 times more valuable than a portfolio that has one share. So does the set of all portfolio vectors form a vector space? Well, if you think about what you learned in linear algebra, there were a couple details that were in there, and they might not have seemed important at the time, but they might be when we look at applications. For example, you can only buy integer numbers of shares. You can't buy half a share or a third of a share or the square root of 2 of a share. So does it matter that the scalars that we have in our definitions in linear algebra are integers as opposed to real numbers, or that they're rational numbers as opposed to real numbers? Well, if you go back and take a look at the theorems, you'll see that a lot of stuff breaks. You can't solve a whole bunch of problems. And we need to decide, as applied mathematicians and as looking as financial engineers, whether it's still a good approximation. And this is the real reason that we're not going into the detailed theorems and proofs, which is that the detailed hypotheses, the exact ones, never hold in the real world. So the basic idea that we want to capture, though, is the structure of markets. And we want to look where these things approximately hold, always being aware that we're making certain approximations. So in the linear algebra unit, we'll take a look at what these relationships are, but mostly we're using the language of linear algebra to understand the relationships among assets. If one asset might be redundant, if its payoffs could be expressed in terms of others. We want to understand how the limits of arbitrage, the idea that Leonid mentioned, that there are a lot of people out there who will take advantage of any discrepancies, actually form and shape the pricing across multiple instruments in the markets that we see. And the language for doing that is linear algebra. That's one thing that we cover in one unit of the course. Finally, we've talked about describing an uncertain world. We've talked about building predictive models that go forward for looking at dynamic processes and what their probability distributions are. At the end of the day, we're going to do something. We're not going to sit around and watch. And some of those things might involve trading. They might involve investments. They might involve hedging and managing risks. They might involve thinking about policy implications of markets and market structure. How we make sure that we could detect a Bernie Madoff, perhaps, and protect investors. How we could think about optimal investments that would help people as part of their retirement planning. So in this part of the unit, we develop mathematical tools that are important for solving economic decision-making problems, where we often need to find the best way to do something subject to resource constraints, whether it's a budget constraint or a physical resource of production. So those are the main topics. And as I mentioned, having the prerequisites can be really important. You'll enjoy the course a lot, but if you don't have the prerequisites in advance, you really should study up beforehand, because the course, the pace is reasonably quick. You'll hear from one of our participants in a moment, I think, but it's hard to study and catch up at the same time. So we want to make sure you're ready, and we've put together a lot of information about that. The prerequisites are really basic probability and statistics, multivariable calculus, linear algebra, and a familiarity with some computing. And I'll be using in the course R for demonstration, but any computing language would work fine. If you'd like to program in Python or in C++ or Fortran or Perl, please go ahead. But the idea of problem solving by writing algorithms is the key idea that we have here. There are a few other things that are nice to have, but not essential because we'll develop them, and courses in these subjects cover a lot more than we actually need. And that includes partial differential equations, optimization theory. We're using a small subset of that. And you certainly do not need to be a software engineer to do any of the programming examples in this class. So that's our overview of the class and some of the things and some of the reasons we're doing it. Igor, back to you.
Great, thank you, Paul. We welcome all of our attendees and prospective learners to enroll in the Mathematical Methods for Quantitative Finance course. Now, I would like to introduce one of our MicroMasters program credential holders, Nader Aletawi, who will share his experience of the program, as well as some tips for preparing and succeeding in our courses. Nader, please.
Thank you, Dr. Egor. So as Dr. Egor mentioned, this program shares the curriculum taught at MIT's campus, and this speaks to how advanced and challenging it is. And speaking from my experience, that is true. It is both challenging and advanced. I can confidently say that the concepts I have learned throughout this program has challenged me, but also allowed me to become highly competent in my job as a quantitative analyst at Mercarian, which is a fintech company building bespoke crypto exchange platforms, where I mainly focus on developing market-making models to provide liquidity to cryptocurrency brokers and exchanges. Other than helping me get this job and be good at it, this program is also helping me in preparation for CFA exams. Still to this day, I do revisit some lectures and some recitations to prepare for CFA. So if you manage to complete this program, despite its difficulty, anything in the finance industry will be easier to reach for you, whether it was a certificate or a certain career you're looking for. And for all of the content's breadth and width that get ingrained in your brain as you go through the weekly lectures and problem sets, I still think that the most valuable experience this program has offered me was the amazing community it contains. Throughout the past 2 years, I have made so many long-lasting friendships from all around the world, where we gathered weekly to help each other out, and sometimes daily, especially on exam nights. And in fact, just last week, I have met with a fellow student in Amman who came all the way from Italy. This exposure to global finance professionals has helped shape me as a person. It has changed the way I think about my career, my future aspirations. And I hope this effect MIT had on me will be carried out to all of this program's students as well. And now to share a few tips for success in this program and completing it, although Professor Paul mentioned this before, but it can't be stressed enough. Study every week on its time. Don't procrastinate, because the material can build up quickly. The pace at which the course moves is really fast. And if you have time, read the textbooks and assigned readings, but prioritize the course content first, because the lectures, recitations, and problem sets do more than enough to prepare you for the exams. But most importantly, remember that you aren't alone in this program and that there are thousands of students taking the course with you. So no matter what you need help with, simply reach out to MIT's teaching staff, reach out to other students, whether it was on discussion forums, whether it was on WhatsApp groups or LinkedIn. Or better yet, find a study partner where you can study weekly together. And please feel free to reach out to me if you need any help on LinkedIn. Thank you, Dr. Egor. Back to you.
Great, thank you so much, Nader, for taking the time and for sharing your experience with our learners. I'm sure they're very grateful to be able to hear some of your thoughts on this. With this, I would like to take the remainder of our time that we have here today to answer some of the questions that you submitted during your registrations and maybe some of the live questions as well. So the first question that many of you asked about whether this program is just a good fit for you, given your current experience or your future goals. So let me provide some perspective on this matter. If you would like to advance your career in finance, this is the right program for you. It introduces you to the most important tools, as you've heard today, used in finance by finance professionals. Even if you're familiar with basic finance concepts, our courses often go beyond the standard material, which allow you to deepen and expand your knowledge of finance. Even the first two foundations courses. So the material that we cover in those two courses just go beyond the standard material that you can find in a textbook. If you would like to pursue a full master's degree in finance or in another adjacent discipline, business, for example, or financial engineering, this program is also the right program for you. It prepares you and allows you to potentially accelerate your degree completion. For example, our MicroMasters program offers a pathway to master's in finance degree at MIT Sloan, as well as other universities. Upon acceptance, you will get credit for courses completed in our MicroMasters program. If you're currently thinking of switching to a career in finance, our program will strengthen your case, but it will not be sufficient on its own. It depends on you as an individual more than a program. If you have the right background and realistic goals, then perhaps yes. But every learner has a unique background, and the real answer is that it varies from learner to learner based on your past and present experience, how much work you're willing to put in, and your future goals. Another question that we often get is about the cost of the program and whether the financial aid is available. So each of the 5 courses that we went through today, so it costs $450. If you purchase the program as a bundle, as many of our learners do, as a way to commit to our program, you get a 10% discount of the total price for 5 courses. So you can purchase the whole bundle for $2,025. You can also apply for need-based financial assistance in each of our courses. And you can, of course, also audit our courses for free if earning a certificate is not something that you would like. Now, another question that we often get is related to career concerns. And so, Leonid, so we received one particular question regarding a job outlook, especially for quant jobs in finance. So the question goes like this: can a graduate from this program with no other significant background or experience in finance confidently apply for a quant position as a qualified candidate? In other words, what is the standalone marketability and value of this program?
So let me say that it's an investment that you're considering, kind of getting enrolled in this program, and it's mostly investment of time and effort. It's significant. Like any investment, there is no guarantee of a high return. It depends, and in particular, when it comes to job placement, of course, it depends on many factors. But let me say that we've had several successful credential holders who obtained jobs in quant finance with no previous experience in the field. And our courses do give you a foundational background in finance. So this will allow you to develop skills and perform well in a quantitative finance role.
Great. So there is a question in the Q&A from Claudia. So what background knowledge in mathematics and modeling do I need? So the important part is that all of our courses have specific prerequisites. So as Professor Mende mentioned, so for mathematical methods course, we've built the whole prerequisite site, which I hope you were able to record and scan maybe QR code. So we highly recommend going to that website and seeing. So Paul just put this on the screen right now. Thank you. So this is where a lot of prerequisites for that specific course are outlined. We also have prerequisites for the Foundations of Modern Finance courses. You can find it on our MicroMasters website. And as I mentioned during my remarks, for derivatives course, Foundations of Modern Finance 1 and 2 are prerequisites. And for the financial accounting course, there are no prerequisites, so you can take it without any background knowledge in business or finance. Paul, we also get sometimes questions about just the programming languages as well, and maybe one of the questions that we had that's been asked before is about the programming language. So you mentioned it before, but for example, if somebody wants to choose between Python or R, will you be using only R, or you will let the sort of learners choose which programming environment?
I mentioned this in passing before, but I'm happy to address it. There's no particular language prerequisite. We do need to standardize. I'm not going to do one version in every language that people know. And so we've used R because we think it is the best for working with data and it has the lowest learning curve. But if you're comfortable in Python, that's completely fine. If you want to have a chance to learn R, that's completely fine too. So it's not required, but the learning examples are not really code or language specific. They're done so that we can do things concretely and give concrete design patterns for coding, but nothing is language specific. I will mention the same thing I tell our students, which is it's a shift when you move from academic setting to working in industry, where you rarely will get to pick the language yourself and where these things change over time. So, you'll find textbooks that have in finance that have code in C++, that have the code in VBA, that have code in other languages that nobody's using anymore. So the world changes, and therefore the principles of finance are the same, but the language, people can work with whatever they're most comfortable.
Great. So let me take one of the questions that just came from Danielle. So do most people who begin the program earn the full certificate, and how many students begin while working full-time or in the financial industry? So Danielle and fellow learners, so for each of our courses, so once you pass the exam, you earn a certificate. If you pass all of the 5 courses, all 5 certificates, you get a credential. So then you become a formal MicroMasters in Finance credential holder. So our courses are pretty time consuming. So on average, it takes 10 to 14 hours a week to work on one course. So if you're employed full time, so you have to, this is a big commitment, as we always tell our learners. So make sure that you can afford to spend at least 10 to 14, maybe 15 hours a week on each of the courses that you take. So this is how time consuming they are. So it certainly requires commitment. Giovanni is asking a question: how do someone apply for Masters in Finance program, our residential program on campus, after completing MicroMasters certificate? So this is easy. So if you just simply Google Masters in Finance MIT Sloan, you will find a web page, and it describes the application process that we have for our residential program. Great. So then another question, whether there is a September session for mathematical methods in 2023. So the full dates for our courses are available on our websites. So the next time mathematical methods course is offered would be the summer of 2023. So not September. It's going to start. It's going to start during the summer. And so with this, I thank you for all of the questions. I think this is all the time that we'll have left for today. If you have any other questions that we didn't answer today, so please email us. We have a dedicated email address. So it's which stands for MicroMasters _fin@mit.edu. And our team will get back to you. So on behalf of everyone involved in our MicroMasters program in finance, we're excited to learn alongside you and look forward to having you in our courses. Thank you again, and look forward to seeing you in one of our courses in 2 weeks, and have a great day or night, depending on where you are in the world.
Thank you.
Thank you.
Thank you all for coming.